Welcome to my podcast where we discuss various topics related to Quebec and Canadian real estate. In today's episode number 12, we're going to be discussing mortgage loans insurance. I'm going to be explaining what is a mortgage loan insurance, why do you need one, and how exactly it works. So without further ado, let's get started. So very straightforward, a mortgage loan insurance is an insurance premium that you're going to have to pay in a scenario where you are putting less than 20% down on the property that you're looking to buy. The premium is going to be added to your mortgage, and I'm going to explain later on how that works. The insurance premium is meant to protect the lender and not the borrower, you. So very important not to confuse that insurance premium with the one that your mortgage specialist or your mortgage broker will be trying to offer you, okay? So that one is meant to protect you, the one they're going to offer you at the bank or through your mortgage broker. But the one we're discussing today is really meant to protect the lender. This insurance is mandatory in Canada, especially here in Quebec where I live. So if you're putting less than 20% down, it's not optional, it's non-negotiable. You're going to have to take this insurance. In Canada, there's three main insurers. The first one, and I believe in the residential space, is the most popular one. It's the CMHC, so the Canadian Mortgage and Housing Corporation. It's what we call here in Canada a crown corporation, which means it's owned by the government. And I haven't looked at the statistic, but I believe in the residential space, it's the biggest one in terms of issuer. The second one is Sagen. So that used to be Genworth, and then the last one is Canada Guaranty. So those are the three main organizations that you're going to have to get your insurance premium from. Once you don't necessarily choose, so depending on the financial institution you're going to be working with, they're going to be advising you which one they're going to be going with. In terms of how it works, actually, before we get to that, I mentioned earlier that you have to take a mortgage insurance premium if you're putting less than 20% down. Now, there are scenarios where you could be putting 20% or more and still get this insurance to help you lower your interest rate. I'm not really going to be discussing that in today's episode, but I just wanted to highlight that. In terms of how the premium works, I'm going to walk you through three examples to better illustrate so you understand what you're going to have to pay. So scenario number one, let's just say you're putting 5% down on a property, which means that your loan is going to be 95%. So that's what we refer to it as the LTV, the loan to value. And according to these examples, I'm going to be using specifically the CMHC premiums. So on their website, they have a table where you're going to see all the different percentage of premium depending on the various scenarios. So I'm going to name three of them here. So the first one, like I said, 5% down, which gives you an LTV of 95%. And with that 95% LTV, according to the CMHC website, your premium will be 4%. So let's just say your mortgage that you're asking for is $400,000. With a 4% premium, that gives you $16,000. That's the premium that you have to pay. And that premium gets added to your mortgage. So your bank, your monthly payment is going to be baked in it. So your total mortgage is going to be $416,000 in that scenario. Let's look at a scenario where you're putting 10% down. So your loan to value becomes 90%, and the premium with an LTV of 90% is 3.10%. So on the same $400,000 mortgage, that gives you a premium of $12,400, and your new mortgage is going to be $412,000. The last example I'm going to give is with a 15% down. That gives you an LTV of 85%, and the premium with an LTV of 85% is 2.8 at the moment. So on the same $400,000 mortgage, that gives you a premium of $11,200, and so if we round that up, that's a mortgage of $400,000 that you're going to have to pay. So really what you have to remember here is the premium will be higher if the LTV is higher. So the less down payment you are putting, you have to expect that you're going to be paying a higher percentage of premium on your mortgage. So it's not necessarily the mortgage amount that really dictates the premium that you're going to pay. It's really the LTV. And I believe there is a maximum. So depending on the mortgage that you're taking, there's a cap of mortgage amount where the insurance premium is applicable to. So those are subject to the different insurer. So when you go on the website, these are all information that your bank is going to explain to you, or your mortgage broker if you're working with one. I'm going to conclude the episode with talking about really an important aspect here. So far we said the mortgage premium is baked into your mortgage. So there's no upfront cost thus far. However, there is taxes on the premium that you will have to pay. So in Canada, we have a federal tax and we have a provincial tax. And the mortgage insurance premium has provincial tax that are applicable, and you have to pay those upfront. So where I live in Quebec, our provincial tax is almost 10%, one of the highest one in Canada. So it's 9.975. If I go back to my first example where we were putting 5% down on the $400,000 mortgage, we said the premium was $16,000. And so if you put the provincial sales tax on the $16,000 premium, that gives you roughly about $1,600 that you're going to have to pay up front. Right? And if you remember, we talked about this in a previous episode where we were talking about the various stages that you're going to go through to successfully purchase your next home. And one of the very first stage was to understand your cost and making sure you have a solid financial plan and you forecast for all the costs. And this particular cost that I just explained gets added to all your other costs that you need to think about, your the notary fee, the inspection fee, and all the other fees that you're going to have to pay before, during, and after you close on the property. That concludes today's episode. So I hope the information was of value to you. I'll see you in the next episode. Thank you for watching.